Come to IFRS 9. IFRS 9 is called financial instrument. In this standard, we are going to learn the classification, recognition, and measurement. Classification, recognition, and measurement. So, what are the different types of financial asset and financial liabilities? First, we'll discuss that. How to identify a particular category of financial asset, whether it is a fair value through P&L account instrument, fair value through other comprehensive income, or amortized cost instrument. How will you be able to find it out? Then recognition principle. What are the principle for initial recognition? What is the amount at which the instrument will be initially recognized? And then subsequent measurement. Also, we are going to cover derecognition, impairment, hedge accounting, derivative accounting in this standard only. This standard is going to be little lengthy and lot of demand will be on your intelligence. So first you answer my question. When should financial asset and financial liabilities be recognized? Initially. What is that trigger point that when this happens, the financial asset or financial liability will be recognized? What is that point? When you will recognize a financial asset or a financial liability? If a customer gives you an order on the phone, please deliver 100 units of goods. Is that the point to recognize the trade receivable as a financial asset? No. When the consideration is received or given? No. Consideration can be given later also. So the answer is when the entity becomes party to the contractual provisions of the instrument. So first answer, write down. When should financial asset and financial liabilities be recognized initially? The whole financial instrument depends on contract. The meaning of financial instrument is it is a contract which results into financial asset for one party and financial liability or equity for other party. So an entity should recognize a financial asset or a financial liability when and only when the entity becomes party to the contractual provisions of the instrument. Entity becomes party to the contractual provisions of the instrument. So if you sell goods, when will you recognize the debtor? The contract is that I will deliver the goods with ownership rights and you will make me the payment. So the moment you deliver the goods with the ownership right to the buyer, that time you have become party to the contractual provisions of the instrument. You make an application to the bank for taking a bank loan. Will you recognize loan liability? Have you become party to the contractual provision of the loan agreement right now? No. So once the loan is approved, sanctioned, transferred to you, that is the cutoff point when the contractual provisions of the agreement or the instrument becomes applicable to you, and that time we recognize the loan in our books. Is it right? And also classify the same according to the measurement basis. So if it is a financial asset, there are 3 classification. If it is a financial liability, there are 2 classification. So example of initial recognition of arrangement as financial asset and financial liability. This list is not exhaustive. For example, unconditional receivable and payable. This is a simple example. Sale of good, purchase of goods. We have seen in the previous chapter IS 32. Trade receivable is also a financial asset. Trade payable is also a financial liability. So when the entity becomes a party to a contract and as a consequence has a legal right to receive or a legal obligation to pay cash, that is the time when you will recognize the debtor or creditor, trade receivable or payable. Similarly, what about the issue of debenture? When will you recognize the debenture, bond, loan as a liability or as an asset? The day you announce IPO or the day the debentures are allotted to the investors? Allotted, because that will be the cutoff point. So when the entity that issues it becomes a party to the contractual terms of the debt and consequently has a legal obligation to pay cash to the debt holder. Okay, so application made by the debenture holder is not the point when you will show debenture as a liability. Once you have issued, then you become obliged to pay interest and principal as per the terms of the instrument. What about derivative, which is again a long lengthy part of this chapter? Recognized as an asset or a liability on the commitment date, that is the date you become a party to the contract, rather than the date on which the settlement takes place. Settlement will take place after 3 months, but we will recognize derivative when we become party to the contract, when we enter into a commitment. For example, in a forward purchase contract, I have entered into a contract on 1st January to purchase on 31st March. So when do I recognize that forward purchase contract? 1st January, date of commitment, not 31st March, the date of settlement. Now there are examples of financial situation, events, transaction which will not be recognized as financial asset or liability right now. For example, planned future transaction. I want to buy equity shares. Will I account it now? I am certain to buy. I have money to buy. No. No matter how likely. Okay. Even if I raise my voice 10 times, your answer will be no only. Are not asset and liability because the entity has not become a party to the contract. Derivative contracts to buy or sell non-financial items which are scoped out of IFRS 9. Suppose you enter into a derivative contract to buy gold and you want to take the delivery of the gold. You don't want to settle on net basis. So it is just again a transaction of purchase and sale of a non-financial asset. But if you are going to settle on net basis, then it will become a derivative, because then your objective is to earn profit from the contract rather than you want to trade in that underlying asset. Okay, are not recognized as financial asset and financial liabilities because these are called executory contracts. Executory contract means contract which will be executed in future, where one party pays consideration, the other party delivers the underlying asset. But remember, if the derivative contract will be settled on a net basis, okay, then it will be within the scope of this standard. And assets to be acquired and liability to be incurred as a result of firm commitment to purchase or sell goods or services are generally not recognized until at least one of the parties has performed under the agreement. So contract to buy or sell is also not recognized as financial asset or liability unless one party has performed some portion of his obligation, then he will show receivable or payable, whatever is that. So you have entered into a contract to buy inventory from other party after 3 months. Will you recognize it now? No, you will not recognize it now. What is the initial measurement principle for all financial asset and for all financial liabilities? Day 1 accounting will be at fair value. So you have to find what is the fair value of this asset or liability, and at that amount it will be recognized. Okay. What about transaction cost? Now here there are two treatments. If the instrument is fair value through P&L account, then the transaction cost will be transferred to P&L account on the date of paying the transaction, date of incurring the transaction cost. But if it is an FVT OCI instrument, or if it is amortized cost instrument, then it will be adjusted in the fair value of that instrument, and it will get recognized over the period of time by using effective interest rate method. So it will go through P&L account, but through OCI, or through effective interest method, through effective interest. Okay. So I'm going to take a question, same question I'm going to take, where I'm going to use that instrument as FVTPL also and FVTOCI also, and I'm going to show you how the accounting will change depending upon the classification. So transaction cost, summarize FVTPL, P&L account. Other than FVTPL, adjust it in the carrying amount of the financial instrument and will be recognized as effective interest rate, because your effective interest rate will change because of that. What about trade receivable, trade payables? Normally these are short-term receivables and payable. And whatever is the transaction price, usually that is the fair value only. Okay. You come to my office and say, I want to buy India's book. I say, okay, take it. Pay me after 3 months. Example only. So I'll pass the entry trade receivable account debit to sales account. Whatever is the transaction price, that will become my fair value also. It won't change much. So normally short-term receivable and short-term payable, we just recognize at the invoice value. Is it right? We don't apply too much of fair value calculation, etc. But yes, you say, no sir, I'll pay you after 3 years. Then it becomes a long-term receivable, and then the role of discounting will become important. So I am going to discount that 300 rupees, find out the present value, that becomes the fair value. And then every year I am going to recognize interest also on that. Is it right? Okay, now we will see a small example of how to calculate fair value of a debt instrument. Just simply take the present value of the future cash flow at the market rate of interest. Present value of future cash flow at market rate of interest. Is it right? That is in the market. This rate is going on. You may be charging more or less than the market rate of interest, but investor will pay amount equal to present value at market rate of interest. Okay. So in this example, X Limited lends rupees 100 million for 5 years to one of the group company at 2% interest when the benchmark yield is 12%. Now, group companies usually do this. They sell to each other, or they give loan to each other, may not be at market price. In the market, the same loan is available at 12%, but you are offering to your group company at 2%. So fair value is not 100 million. Fair value will be present value of future cash flow discounted at market rate, which is 12%. So what is the fair value? Can you solve? Assuming that you are going to repay 100 million after 5 years. So write down calculation of fair value. Year, cash flow, present value factor you will take 12%, market rate, and present value 1-5. 1-5. You are going to first pay the coupon or receive coupon for 5 years. 100 into 2%. 2, and in the 5th year, redemption 100. So dear student, tell me, what is the annuity factor for 5 year at 12%? Come on. 3 point how much? 6047. And 5th year factor at 12%. 567. Very good. Multiply 2 into this number. 7.2095 and 56.74. This is the fair value of this loan. Take the total. Is it 63.9495? 63.9495. Check the total. Is it right? How much you are transferring to other party? 100. What he is going to pay you in return in present value term is only 63.9495. What about the difference? The difference is called a fair value loss. It's your loss. It's your loss. You are giving 100 rupees. You are getting 63.9495. So the difference will be treated as fair value loss. So write the journal entry. Is it given in your notes? Journal entry. Oh, amount is not written. So sad. Write down. Fair value loan asset account debit. Substance over form. Substance over form. This is one example. In substance, we are giving him a loan of only 63.9495. And remaining is my fair value loss. So I will account for this asset at fair value. And if the fair value is different from transaction price, this is called transaction price. Then the difference will be my gain or loss, which will be transferred to profit and loss account balancing figure. 36.0505. Approximately 36.0505. Okay. There is a note in the page number 2. This type of fair value loss is popularly termed as day one loss. Since fair value is measured based on observable market rate, the gain or loss is recognized at initial recognition. Okay. This small example we will keep in mind for many other problems also. This is how fair value for debt instrument will be calculated. Now next question for you is, what if the fair value of the financial asset or a financial liability at initial recognition differs from transaction price? Refer the example above and give me the answer. It will be recognized as day one gain or loss in profit and loss. Already done in the previous question number 2. Write down the note. To keep you awake, I have ensured that you are busy. Okay. So the difference is recognized as a gain or loss. As a good student, practice today all questions that we have covered. Okay. The difference is recognized as a gain or loss on initial recognition. It is also called day one profit or loss. Normally, but not necessarily, transaction price and fair value normally on day one will be same. Normally. But in situations like this where loan is given at a discounted rate, concessional rate, then in that case the fair value and the transaction price will differ, and that difference will be treated as gain or loss. Depending upon what is the difference, accordingly the accounting is done. For example, in the government grant chapter, if the loan is received from government at a discounted rate, in order to help the industry or an entity, the government can give loan at concessional rate. So in your standard on government grant, we calculate the present value of the loan at market rate, compare with the actual loan given by the government, and the difference is treated as government grant. There the government grant is recognized over the period of the loan on some systematic basis. Is it right? So there also you have used the same concept. If suppose you have an employee, market rate is 12%, loan given to employee at 2%, same question, the difference will become employee cost. The difference will become employee cost. And if the employee has completed the vesting condition, it is treated as an immediate expense. If the employee has to serve some more year to fulfill the vesting condition, then it will be a portion over the period of service. Is it right? Same thing. What about transaction cost? We have discussed, but once again in detail. While solving the problem, be very careful. Transaction costs are incremental costs that are directly attributable to acquisition, issue, or disposal of a financial asset or a financial liability. So we are talking about those transaction costs only which are related to acquisition, disposal, issue, not in general any transaction cost. So for example, when you issue equity share, the transaction cost will be all the issue expenses relating to equity share, like regulatory expense, legal expense, okay, printing and stationery relating to issue, etc. Same thing for debenture, etc. Example, fees, commission paid to agent, advisor, broker, dealers, levies by regulatory agencies and security exchange, transfer taxes and duties, stamp duty, because when you buy the investment, you will have to pay the stamp duty in some cases, sometimes they are exempt. However, debt premium or discount, financing cost is not transaction cost. Internal administrative cost, your day-to-day administration cost, is not transaction cost. Debenture issued at a discount, face value 100, issued at 95. 95 is what is our starting point. At 5 rupees discount will not come in our picture at all. Is it right? So I have made a small summary which will keep in mind throughout this chapter. What is the treatment of transaction cost? For debt instrument subsequently measured at either amortized cost or FVTOCI. In this chapter there are many variables and that is the challenge. It should be debt instrument and either it is at amortized cost or at FVTOCI. If it is FVTPL, will come below. Three types of instruments are three classification are there: FVTPL, OCI, amortized. So we are talking about the amortized cost and FVTOCI. In this case, the transaction cost will be included in the calculation of effective interest rate, EIR, or what you know as IRR. So automatically it will get included in the calculation of effective interest rate only, and then they will be amortized through P&L account over the term of the instrument. So the transaction cost will get included in effective interest rate. Using effective interest rate, we calculate the interest amount. So the effect of transaction cost goes into P&L account through effective interest rate. What about the equity instrument designated as FVTOCI? The transaction cost remains in equity and are not subsequently reclassified to profit and loss. Okay. An entity may choose to reclassify within equity the cumulative gain or loss which includes transaction cost For example, when the investment in equity instrument is derecognized. In simple terms, it will shift from one equity account to other equity account within the equity. Within SOCI, we will shift from one head to other head, but not to be routed through P&L account if it is equity instrument designated as FVT OCI. And what about the financial instrument classified as FVTPL? Now here it can be debt or it can be equity. For both debt and equity instrument which are classified as FVTPL, the transaction cost will be immediately recognized in profit or loss. So that is why here we have not mentioned the equity debt. It is applicable to both. Okay, solve this small example. An entity acquires a financial asset for rupees 100, purchase commission of rupees 2, and that is measured at amortized cost. So what will be the initial recognition amount? Initial recognition. So you have to just tell me whether this 2 will be charged to P&L account or it will be added to this 100 rupees. Added to this 100 rupees because the instrument is amortized cost. So if the question is amortized cost or FVT OCI, the answer is 102. And later we will compute the EIR. While computing EIR, I am going to take 102 rupees. And then my EIR will be calculated, which will include 102 rupees for computation purpose, means transaction cost will effectively get recognized. Write the answer properly. Initially the entity recognizes the asset at rupees 102. If the financial asset is measured at amortized cost, the transaction costs are amortized to profit or loss using the effective interest method. Are amortized to profit or loss using the effective interest method. Using the effective interest method. Okay. Same answer you will write if it is FVT OCI. But if it is FVTPL, you will write it will be recognized as 100, 2 rupees will be charged to profit and loss. Now we will come to accounting of financial asset. So our today's topic is financial asset. Financial asset will have to be classified into one of the three categories for subsequent accounting. First you do the initial accounting, that is same. Okay. Thereafter the subsequent measurement will depend on the classification. Okay. What are the three classification the standard has suggested? Amortized cost. So basically in case of amortized cost, our intention is to hold it till maturity. And we are interested in collecting the contractual cash flow which the asset would generate. So what is my purpose of this instrument? Invest in it and receive the cash flow that is promised to be delivered to me. I am not interested in selling this asset. So even if the market prices are going up or down, I am not bothered because I don't have to sell it. Although in exceptional case I may sell it, but that is exceptional. In general, my objective is to hold it till maturity and collect the contractual cash flow. Second type of instrument we will call FVT OCI. Now here the objective of the management is both. It wants to hold it and collect the contractual cash flow in case of debt instrument. But it also thinks if mauka mila, if I get a chance, I am going to sell it also. So I am keeping the possibility open that I may sell it also. In case if I found, oh, the market value has gone 2 times, let us book the profit, sell it, or I can hold it till maturity. So that is why they have said fair value through other comprehensive income. Now why fair value this time? Because your intention is to make profit by selling it also. So you are taking the risk. You are exposing yourself to the market. So the standard says since you are exposing yourself to the market, because you can sell it also, value at fair value. But at the same time, your main objective is not to trade in this instrument. You might sell it, but that is not your only objective. So therefore, don't route it through P&L account. Route it through OCI, and when you actually sell this debt instrument, then you transfer it to P&L account. So that is a logic they have designed for this instrument. And the third instrument is FVTPL, fair value through P&L account. Here my objective itself is to trade in that instrument. Make profit by buying and selling. Make profit by trading. So therefore they are saying when you are exposing yourself to market, why not to transfer the fair value change to P&L account only, because that is my objective, to make profit or loss by trading in that instrument. So these are basically for short duration. Okay, here my objective is buy, and in case if the market goes up, sell. So FVTPL. So this is for debt instrument. Debt instrument will have 3 classification: amortized cost, FVT OCI, FVTPL. But if it is a equity instrument, financial asset equity instrument, you are the equity owner in another company, then in that case there are only 2 classification. Which 2 classification? If it is a financial asset which is an equity instrument, 2. Which 2? FVTPL, FVTOCI. FVTPL, FVTOCI. Again, the how to identify it is FVTPL or FVTOCI if the objective is to trade. Keep it for short term, buy, sell. Okay, then FVTPL. But if it is a strategic investment, investment is for a longer period, then FVTPL. Sorry, FVT. So that management has to make a choice about equity instrument. For equity instrument, management has to check, is it for trading purpose? Yes, FVTPL. They are not sure. Then they have to make a choice. Do I want to classify it as FVTPL or do I want to classify it as FVT? Both choices are with the management. But this choice is irrevocable. Irrevocable means once you have classified as FVT OCI, then subsequently you cannot reclassify it as FVTPL. So make the choice carefully. Okay. Investment in equity instruments are required to be measured at FVTPL, because normally the intention of most of the people who invest in equity share is to make the profit. But yes, you can hold it for a strategic reason also, for a long term also. Except equity instrument meeting certain criteria may be irrevocably designated as FVT OCI. In this chapter, wherever the management is given a power to designate an instrument in a particular manner, then later on that designation cannot change. Is it right? Because I am giving you a power, you can't misuse it. So I am allowing you to choose FVT OCI classification for equity instrument. But once you make a choice, remember it is irrevocable. Except on initial recognition, except for financial assets that are designated at initial recognition as at FVTPL, The classification of financial asset is based on entity's business model for managing the financial asset and the contractual cash flow characteristics of the financial asset. Now some more complication, especially for these two category. How will you identify whether a debt instrument can be categorized as amortized cost or FVTOCI? So two tests we will understand. One is called business model test and the other is called contractual cash flow characteristic test. Okay, BMT CCFT. Okay, so let us see, because accounting will change accordingly. In the exam they may give you the classification. Okay, so you have crossed one hurdle, but they may not give you the classification. So first you have to check the classification. First you have to check whether it is financial instrument or not. Okay, then you have to see the classification and then the accounting. So classification for asset could be one of the three: FVTPL, FVTOCI and amortized cost. And there are two types of financial asset: debt instrument, equity instrument. Okay. Now in debt instrument, we are going to first ask this question. When you read the problem, check this condition number 1. Are the assets contractual cash flow solely, means only, payment of principal and interest? Are we going to receive cash flow? That cash flow should represent only interest and principal. Other than that, if you are receiving any other cash flow, then contractual cash flow test has failed. And if you fail the contractual cash flow test, that means the instrument will be classified as FVTPL. Okay, contractual cash flow test means the cash flow that you will receive from the instrument should only represent the principal payment and the interest payment. And interest payment should also be based on the time value of money, the risk involved. Is it right? If your interest rate suppose is 35%, but the market rate is 9%, then your interest rate 35% not only interest, there is something else hidden in that. Your CCFT test has failed and then the instrument will be classified as FVTPL. But suppose you have passed the first hurdle. The next test is check the business model. There are two types of business model they have discussed in this standard. One is your intention is to hold the instrument and collect all the cash flow that the instrument will generate. Example would be, let's say, government bond, investment in a government bond. You also do it out of your hard-earned stipend. So what your objective is? It's a 5-year bond. They pay you interest every year. You collect it. On maturity, you get the redemption value. So that business model test is to hold the instrument to collect the contractual cash flow. Is it right? So in the exam, if the instrument is a debenture, bond, loan, fixed deposit, and nothing else is given, you can simply assume that the objective is to receive the interest and principal. Okay, and you can simply classify such debt instrument as amortized cost. But suppose you don't have this business model. Your business model is to collect both contractual cash flow and also to sell. You're keeping both the options open. You will collect the contractual cash flow. That means you are interested in the interest income also. And you are interested in making profit also if the situation warrants. Is it right? So you can't be FVTPL also and you can't be put under amortized cost also, because you are taking risk, market risk. So if you are taking market risk, you are exposing yourself to that market, value at fair value. But at the same time, you are not trading in that. You may not sell it also. FVTOCI instrument, you may not sell it also. You can hold it. But you are keeping the option open to sell it. So therefore the change will be routed through OCI. And once this debt instrument is derecognized, then any balance lying in OCI will be transferred to P&L account. So unrealized gain or loss will be transferred to P&L account because it has now become a realized gain or loss. Okay. So first apply contractual cash flow test. Means the cash flow should represent only interest and principal. Okay. Then apply business model test. If business model is to collect all contractual cash flow, amortize cost. If business model is to collect contractual cash flow and sell also if the need arises, or if you want to make profit, if you want to achieve a target rate of return, then it will be FVT OCI. First we have to only understand how to identify. Is it right? Like you have deposited in a bank FD and you want to earn the interest. What will be the classification? Amortized cost. You have invested in debentures of Tata Motors Limited. What is your objective? To receive the interest and then redeem redemption value. Amortized cost. Okay. But many companies invest in bonds and they can sell it also in future when the market price goes up. Then they will show FVT OCI. So many corporates, mutual funds, banks, insurance companies, they actually invest in bond, and the moment the RBI announces tomorrow the interest rate has gone down, value of the bond goes up, and then you sell it and you can make profit also. So they will call it FVT OCI. Now, can we call an equity instrument as amortized cost? Equity instrument cannot be designated as amortized cost. Answer is simple, it does not pay interest, contractual interest. So my contractual cash flow test itself has failed. There is no contractual cash flow. You get the residual income. Is it right? So equity does not fit into this definition. So therefore for equity, the method of identification is different. Because equity does not give you a fixed interest rate. There is no contractual cash flow in equity. So for equity, we have to first ask whether the objective is for trading. Are you going to trade? Trade means to buy and sell in the near future. Okay. If the answer is yes, then there is no choice. You have to classify it as FVTPL. Means any change in fair value will be shown in profit and loss account because that is your objective, to make profit. So even if you are holding it and if the value of the instrument changes, you recognize in P&L account only. But if the answer is no, my objective is not for trading, then the management has to make a choice here. If the objective is not to trade, then you decide what you want to do. Then you are given a choice. You can either classify it as FVTPL or you can choose the FVT OCI classification. Okay. Once you designate FVT OCI, then subsequently you cannot convert into FVT PL instrument. And the change in the fair value will be recognized in OCI. Second part of the statement of profit and loss, and will be shown in SOCIE. When this equity instrument will be derecognized, it will be only shifted from one equity account to another equity account. For equity instrument, OCI balance will not be transferred to P&L account. For debt instrument, the OCI balance will be transferred to P&L account. Okay. Now some quick discussion on BMT, business model test. Business model can be of two types: to hold the instrument and collect the contractual cash flow, or to hold the instrument to collect the contractual cash flow and sell also. So first business model, financial assets that are held within this business model, the objective is to hold asset in order to collect contractual cash flow over the life of the instrument. That is, the entity manages the asset within the portfolio to collect those particular cash flow instead of managing the overall return on the portfolio by both holding and selling the asset. So here my objective is not to trade only, not sell only. So standard is also accordingly designed. Don't measure them at fair value. Measure them at amortized cost. Amortized cost means cost adjusted for difference between the interest earned and the interest received. Adjusted for the difference between interest earned using effective interest rate and interest received as per the contract. Okay, so that on maturity the book value and the redemption value becomes equal. Okay, I'm not interested in selling this. So cost. What is the point in measuring it at fair value when I'm not going to sell it only? So cost model subject to some adjustment. And then second business model is hold to collect contractual cash flow, but you are open to the idea of selling it also. Okay. So example, such type of business model may be to manage everyday liquidity needs. So you invest some amount in debt instrument, which what I said most companies do. Surplus money, you don't know what to do with that. Park it in some debt instrument. If need arises, sell it, convert into cash. If need does not arise, keep on receiving the interest. So that is your managing your day-to-day liquidity needs, or to maintain a particular interest yield profile, to earn a particular rate of return, or to match the duration of asset to the duration of liabilities that those assets are funding. Now, duration of asset and duration of liabilities. Have you ever heard this duration in the SFM subject, strategic financial management subject? Duration. What is duration? I don't know. I am not an SFM teacher. Duration means the average maturity period of a bond. Now some brief discussion why this line is important. For exam purpose, not important. When we have to pay some liability after a certain time period and we want to fund it. Fund it means we want to invest in some instrument so that with interest this investment will become equal to the amount of liabilities to be paid. Is it right? So that is called matching of duration with duration of liability. So that the idea of duration matching is, if there is any change in market interest rate, what will happen? Market interest rate will change. So your reinvestment income will change, value of the bond will change. But the change in the value of the bond and the change in the reinvestment income compensate each other and you achieve a desired rate of return. Is it right? So if your objective is to match the duration, you're not going to hold it till maturity. If your liability is due after 5 years, but your bond maturity is 7 years, you're not going to keep it for 7 years. You're going to sell it after 5 years to match your liability. In this case, your objective is to hold and sell also. To achieve such an objective, the entity will both collect contractual cash flow and sell the financial asset. Which model will have a higher frequency of buying and selling? Amortized cost or FVTOCI? FVTOCI will have a higher frequency compared to amortized cost, and FVTPL will have even higher frequency than FVTOCI. Okay. This is because selling financial asset is integral to achieving the business model objective instead of being only incidental to it. So here my objective is both earning the income also and making capital gain also. However, what the standard says, there is no threshold for the frequency or value of sell. How many times you are going to buy or sell? What should be the value of buying and selling? We have no such criteria It is left to your judgment. Okay. Now we will talk about the second test called contractual cash flow characteristic test. It means the entity should collect contractual cash flow. Contractual cash flow should represent only two items, principal and interest. Principal does not require too much of explanation. It is the amount that the bond will pay, the face value. Of course, it may include some premium also. On redemption and interest. I have defined what is principal also. Principal is the fair value of the financial asset at initial recognition. However, principal may change over time, over the life of the financial asset, if there are repayments of principal also. For example, if the bond is redeemed in, let us say, 2 installments, then the principal amount at the beginning and after the first installment will not be the same. What about interest? How do you know this cash flow is interest? It should represent time value of money. Time value of money means, suppose I invest the same money in a government bond for this maturity. What rate of interest I could have earned? Then it should represent the credit risk associated with principal amount outstanding during a particular period of time. Now, credit risk means risk of default. Investing in a government bond is different from investing in a debenture of a corporate. Yes or no? So you would have to charge some premium if you are a lender. If you are a borrower, you will have to pay the premium for your credit risk. Third is, it may include any other basic lending risk also. Okay. And it may also include a profit margin of the lender. Suppose you are a financial institution, NBFC kind of entity. What is your business? You raise money at 7-8% and you give loan at a higher rate. Why do you charge a higher rate? Why injustice? Because you have to make some profit also. Is it right? So if your interest includes following 4 items: time value of money, compensation for credit risk, compensation for any other lending risk like risk of default, risk of prepayment, and some profit margin, normal profit margin, then it is interest. But if your interest consists of something other than this, in the name of interest you are paying something else or receiving something else, then it is not a contractual cash flow. Then FVTPL will be the classification of such instrument. Okay. The assessment as to whether contractual cash flow are solely principal and interest is made in the currency in which the financial asset is denominated. Okay, that is simple and not very important. Only debt instruments, discussed earlier also, only debt instruments can meet the contractual cash flow test, because in equity instrument there is no contractual cash flow, there is no interest, there is no redemption value. Derivative asset and equity instrument will not meet the criteria of CCFT, which means derivative and equity instrument can never be classified as, fill in the blanks, amortized cost. In fact, derivative cannot be classified as FVT OCI also, because the objective of derivative is to trade only. Objective of derivative is basically to trade or to hedge. But if it is for hedging purpose, then hedge accounting rules apply for derivative. Now, to understand the concept, some examples will come and you have to tell me, is it FVT OCI instrument, or can we classify it as amortized cost or FVTPL? Check your understanding. There is a question. Is the answer also printed? No. So sad. Solve. Give me the classification of this instrument with these features. Now such question requires you to think. Okay, mechanically you can't get the answer. Just check, are there contractual cash flow? 1. Is the entity going to receive all contractual cash flow? Yes. Then amortized cost. No. Objective is to collect and sell. FVT OCI. If both conditions fail, FVTPL. Okay. 5 seconds more. Question is printed in your notes. Answer is not printed. So what is your answer? Amortized cost? Because it's not prepayable. So write this answer. Even if it is a zero coupon bond, there is a contractual right to receive the redemption value, if not interest. Is it right? And if you're going to hold this instrument till maturity, this can be classified as amortized cost. At the date of acquisition, write this answer. At the date of acquisition, this is a zero coupon bond. So student will say it does not pay interest, so there is no contractual cash flow. There is a principal amount which includes all the interest accrued till maturity. Yes or no? Okay, first I forgot one thing. Do you know what is zero coupon bond? Otherwise the whole Ramayana will be over and you will search for Sita only. Zero coupon bond means, suppose the face value is 1000, it is issued at 600 rupees example, and then interest will accrue, and with interest 600 plus 400 interest which has accrued, 1000 rupees will be paid to you on maturity. So there is an interest payment, there is a principal repayment, but all cash flows takes place in one bullet point at the end of the year. Okay. At the date of acquisition, entity Y has a financial asset that provides a fixed return of interest and repayment of principal. The fixed return is the difference between the amount paid to acquire the bond, and the amount due from entity X at redemption. The instrument will be classified as amortized cost. The instrument or the ZCB will be classified as, this was your question, amortized cost, as it meets business model test and contractual cash flow test. CCFT, contractual cash flow test. BMT means business model test. Okay, try one more. Floating rate note. I'm taking some difficult examples because exam is like that only. Floating rate loan, now again there is a challenge. Here the interest rate is not a fixed rate, it's variable. So the question is, can variable rate interest also satisfies the contractual cash flow test? The answer is yes, even though it is variable, but there is a formula to determine that variable amount. Is it right? So a financial asset that is a variable rate of interest that consists of consideration. But even if it is a variable rate, it should consider time value of money, credit risk, any other basic lending risk, and some profit margin. So if that variable rate is designed in such a manner, say for example LIBOR plus 5%. So LIBOR may represent your basic time value of money, and that 5% that you are charging extra is for credit risk, other lending risk, and some profit margin. Then even this will be able to meet the contractual cash flow characteristic test. Once you pass this test, then apply business model test. Then apply business model. And if business model is to hold till maturity, then amortize cost. If the business model is to hold or sell, then FVT OCI. So on this point, we will take one small example. Entity S lends rupees 10 million to entity T. Term of the loan require entity T to repay rupees 10 million in 3 years, and the loan is not prepayable. The interest rate on the loan is based on, in this example, LIBOR plus 2% on rupees 10 million payable in arrears at the anniversary date of lending. Means exactly after 12 months. Okay. So if the loan is given on 1st January 2019, the first interest will be paid on 1st January 2020. Doesn't make any difference. The rate of LIBOR is determined in advance, that is at the start of each annual period. So for the first year, we'll decide the rate today. Again, 1 year is over, we'll decide the rate on the next year, 1st January. Okay. So what will happen next year? The rate of interest may change because LIBOR may change. There are no other feature in the contractual terms that result in any variability in contractual cash flow. Means contractual cash flow represent only interest and principal. That is a line in the standard, solely represent payment of principal and interest. Whether contractual cash flow characteristic test is met, only this much we have to answer. I don't have to answer whether it is amortized cost or FVTUCA because business model is not mentioned here. So write down one paragraph, small paragraph. Even though how to write the answer in the exam is also an art. Okay. Even though the interest on the loan is partly fixed, that plus 2% is fixed, and partly variable, that LIBOR is the variable component, 2% is fixed component. The variable element is determined by reference to a market interest rate, and therefore for entity S, the loan gives rise on specified dates. To cash flows that are solely payments of principal and interest, amount outstanding. Hence, the contractual cash flow characteristic test is met. Hence, CCFT is met. Hence, exam don't write CCFT. Okay. Not allowed so far in the exam. Hence, CCFT is met. Okay, try one more question. Entity Q. See, the topic is to check whether contractual cash flow test is met and then whether the instrument can be classified as amortized cost or FVT OCI. Entity Q lends rupees 10 million to entity P. The term of the loan require repayment of 10 million by entity P in 5 years. So very common question, day-to-day question, lending of money. Interest rate is payable in arrear and is calculated as follows. Fixed rate of 6%. This represents time value of money plus a credit margin that reflects the credit risk of the borrower. Okay, at the date the loan is originated and is automatically adjusted on an annual basis during the loan term to reflect changes in the borrower's credit risk. That means we have said that we will charge you a credit margin for your credit risk. Every year we'll get the instrument credit rated by a credit rating company. And if the rating changes, the interest rate will change. Okay. So here it is opposite of the previous question. Here this fixed rate is there, and as the rating would change, your premium would change accordingly. Whether contractual cash flow characteristic test is met. These are the way the banks, financial institutions now design the loan agreement. Okay. You should know this because after some months you'll join some big company, NBFC, bank. These are the products they are offering in the market now. So what is your view? We have to see whether 4 cash flows are there. Time value of money, credit risk. But this time because change in credit risk means your interest rate can also change. It is okay. Even if you charge more or less in the next period, it is due to credit risk only. And there is no other element in this case. So can the correct CCFT test be met? Yes. So write down one small answer. Assuming that all contractual terms other than automatically adjusting the credit margin represent solely payment of principal and interest. The inclusion of credit risk adjusted margin would result in the instrument passing the CCFT. Okay. Can you write like this in the exam? You will say no, yes, maybe, none of the above. Okay, one last instrument. Then we'll do the accounting of these 3 categories. Perpetual debt instrument. We have seen zero coupon bond, floating rate bond, now perpetual debt instrument. Now this instrument only pay coupon periodically. There is no fixed redemption date. Redemption date is indefinite. So can we say that this instrument also meet the contractual cash flow test? Yes, if your interest represents time value of money, credit risk, liquidity risk, and a profit margin for the lender. Variability in the contractual cash flow due to factor other than this will generally result in the instrument failing the contractual cash flow characteristic test. But otherwise, this instrument can also be treated as instrument which satisfies the contractual cash flow test. And if you are going to hold it till perpetuity, you can classify it as amortized cost also. And if you are going to hold it and sell it, then you can classify it as FVT OCI also. Okay. Now the accounting begins. First instrument, FVTPL, simplest of the lot, because there is no major headache here. Just first day you record at fair value, subsequently at fair value, at the time of sale or derecognition, fair value, change in fair value will be always routed through P&L account. Transaction cost at the time of purchase or at the time of sale, P&L account. Any interest or dividend received, P&L account. No need to use effective interest rate method here. That makes complicated. Is it right? Because my objective is to make profit by trading in this instrument. So any financial asset that does not qualify for amortized cost or FVT OCI must be measured subsequent to initial recognition at FVTPL. So this line is applicable for debt instrument. Any debt instrument which does not fit into the other two will come into FVTPL. But for equity instrument, if the management wants to choose an equity instrument which is not held for trading as FVT OCI, then it can go to FVT OCI. Okay. In addition, here you write in bracket, this line is applicable for debt instrument. And this line is applicable for equity instrument. In addition, financial assets that are held for trading, always FVTPL. Don't apply any other condition there. So because the objective is to buy, take the benefit of market movement and make profit. So therefore you are going to measure it at fair value through P&L account, because that is my objective. And initially measured at FVTPL, subsequently also measured at FVTPL. So the summary of the previous slide is, in debt instrument, if it does not meet the definition of amortized cost or FVT OCI, then it is FVTPL. In equity instrument or debt instrument held for trading, FVTPL. If an instrument, equity instrument not held for trading and not designated as FVT OCI, not held for trading and not designated as FVT OCI, equity instrument will become FVTPL. Is it right? Now we'll continue tomorrow.